Hey everybody, welcome to another holiday weekend free edition of our Trader User Group. This is the weekly roundup for the trading week ending this past Friday, Jan 17, 2020. Everyone, I'm Preston Brent. Thanks for tuning in. Well, this week's theme, probably the best described as Groundhog Day, where the day just kind of keeps repeating itself, new all-time highs all the time. I mean, we saw the Dow, S&P, NASDAQ, Russell all finish strongly in the green, new all-time highs made. Volatility coming in a little bit more. It fell down. It closed the week at 12.10, 1210. World markets, every major world market was up last week with the exception of China. It was down about 54 basis points, but all other world markets, primary world markets were up. Sector performance, though, we did see the utility sector come in and have a very strong finish at 3.7% to the upside. Energy was not so good this past week. The other thing I'm looking at, if we look at the trailing PE ratio for the prior 12 months, it's up at a whopping 26. The forward PE ratio is sitting at 19.45. So even though they've reduced the forward PE ratio by about 25% from the trailing 12-month PE ratio, it's still elevated, guys. But we're seeing the interest rate close this week, the 10-year rate this past week at 1.83. And the dividend yield, S&P dividend yield, is averaging about 1.8. So there's still this not a competition for money. I mean, the market's rapid rise in 2020 already shows that momentum is still very strong across every single U.S. index. Okay, and after this really amazing year we had last year in 2019, one of the things I've seen is that the bond market has been very unusually kind and probably more supportive of the overall equity market direction. I mean, we've seen this rise in PE multiples to heights we haven't seen since the early 2000s. But we can continue to see higher price action if interest rates remain low and we've still got subdued inflation. In fact, I'm telling our members that the markets, even though we're a little bit overbought and a dip is probably likely, I don't see anything in the charts or economic indicators near term that would indicate that buyers would not step in on any price action pullback. So the buy the dip mantra still remains, guys. But like I said with the bond market, these lower yields really enhance the attractiveness of equity markets. I mean, it has given rise to that term that we used back in 2014, 15, and 2016 of TINA, there is no alternative, meaning money needs to seek yield. So these lower bond yields have induced corporations, though, to borrow more money. Already in 2020, I was reading a report out of Barron's this weekend that over 20 billion in new corporate debt issuance and bonds so far this year, 20 billion. And all this money is helping to stoke huge corporate stock buybacks, which of course, as you guys know or should know, it enhances earnings per share. We've seen in 2020 already, I mean, what are we, 17, 18 days into the year? Over 1 trillion in money flowing into bond funds. All right. So, but keep in mind, too much of a good thing always comes with risk as well. In this case, if we see, I think one of the bigger risks for 2020 is if we see the possibility of higher inflation due to possibly higher wage growth, then that in turn would raise borrowing costs, thus impacting earnings per share. Corporate debt is going to be a heavier lift on the expense item, on the income statement and balance sheet, and it's going to increase or could decrease default rates in some of the bond market, especially the junk bond market. But so far, the corporate bond market, the yield spread between junk and investment grade, or even between the 10-year government treasury note, is still at a much lower than the historical average of about 5.5%. So that still shows money is easy right now. But keep in mind, these things always do come to an end. I just don't think they're going to come to an end right now. And any dip, as I'm telling our members, is an opportunity to buy. Globally, we've also seen there was like about 14 trillion, maybe a little bit more in negative interest rates. That's come down to about 11 trillion. So about 3 trillion has moved back up above zero. So that's good. But even at 11 trillion, that's still unsustainable. Okay. And we've also seen the U.S. Fed under our illustrious leader, Jerome Power Ranger Boom Boom Powell, they just announced this past Thursday that they're going to be issuing new 20-year bonds. And we haven't had those here in the U.S. since in the 60s, and they've got to fund our debt, so they're going to be issuing these bonds. Now, what that does is it's going to drive up interest rates on the back end of the curve, um, but it's going to or drive it's the it's going to affect the probably the best way to say it is it's going to expect the yield curve. It's going to steepen the yield curve. Okay, so as usual, the interest rates on the front end of the yield curve are going up, and it's going to kind of suppress some of the duration of the market on the back end side, primarily with this repo market that the Feds are doing. They don't call it quantitative easing though. They want to call it that. But anyway, the yield curve has steepened from being inverted in the summer of last year. All right, so the Feds have done that on purpose. The other thing that we saw last week in the trade action was that they've got the phase one trade deal done with China. And price action was happy with the results, regardless of personal opinions on whether it'll last or not, or what is the details behind it, and that kind of thing. Price action for the moment has been a very favorable response, and that's also on the back of the USMCA trade deal too between the U.S., Canada, and Mexico. So those all served as a very nice week for the market. So now this holiday weekend, people can relax, watch a little bit of football if you're into that, or just take a day off and just enjoy the extra day. Okay. And then we're going to get back into things coming back into Tuesday of next week. We will see limited action in futures, though. What you see on the screen here is an Ichimoku chart, daily chart of the S&P 500 E-mini futures. You can see we're bumping up against the next resistance point here on the fib node of 3338. And you can see every time we've hit these fib nodes, they do serve as support or resistance. I mean, right there, it held us up for a week. We came down and tested it there. And then right here, it held us up for a week. We came down and it found support right there. So I suspect we could run back up in this area here. But I think any pullback, what we call a dip, I think it'll probably take us back below the 3,300 level. This would be what I would consider our S1 level right now. Now you can see this green cloud serves as support zone. You can see this energy meter right here, just basically saying that every time we've had these dips in the market, buyers step in, and the level of buying, the energy of buying is the same. Typically, when you've got, if you've got the level of energy down at this level here, but you've made new all-time highs, you've got that divergence in energy, which suggests we're going to have a further pullback. But we're not getting that. All of these show very strong energy. And what's happening, guys, is that there is so much money on the sidelines. There's so much cash waiting to be put to use. You get that, not quite a FOMO, fear of missing out, but in a way you do get money coming back into the markets. And with this rebalance and moving into 2020, we're seeing some of that as well. So again, you don't want to chase markets. For our members, I've reviewed, really in detail the best way to get on board a stock or any kind of asset class that's been running up for a while. What's the best way to pick an entry? So I'm not going to do it here in our weekly roundup for everybody, but for our members, you guys understand the best way to do that. If you're not a member of our group, I highly encourage you to come in and check it out. We're doing really well. But you can see the RSI here as I shift over. We're back in overbought territory again. And every time we get up to this level, we do experience a little bit of a dip. Okay. Again, for us, a dip is less than a 5% drop in price action. So that would not surprise me at all. If we look at the MACD, you can see again with the energy, the energy strength really from here and the MACD, it does show that there is no divergences here. So price action really wants to go higher. Okay, so that's a little bit on this holiday shortened weekend, what I'm seeing in the markets. Now, let me just shift the screen over here just 1 minute, and we're going to go take a look at volatility. Let me just shift this over here so that you guys can get into it. Let's see, where are we? I got so many monitors on my office desk here. Okay, you can see this color-coded chart. It's a daily chart of the VIX, and you can see we're solidly in the green right now. When we're in the green, it demands more. It demands a different approach in the option market. And then once you move into the yellow, into the pink, and into the red, and then back up into the black, where you got the black swan kind of events, it just gives you an area where you want to be considering different kinds of option strategies, especially for you option strategists out there, on things that work better, putting the wind at your back when you're trading options market. But you can see here, I don't see us going much lower than this. In fact, we're getting a little bit of a divergence to the upside. So that does suggest the risk of a bigger move, of course, is to the upside. If we look at the skew between the front month and back month, um, if we look at the front month, you will see it's close to zero, because what happens is the skew moves to zero when the VIX or when the, the volatility futures expires, because it must equal the VIX, because the VIX is based on the front month volatility futures. And when the front month volatility futures expires, the VIX equals the front month volatility futures. But look at the back month. The back month is amazing. Look how deep we are in the green. Again, the skew is very steep, which suggests there is no fear out there. It's the way it should be. It's called contango. So we've got a skew that's very, it shows no fear going out into the February, March timeframe, at least for this first quarter. There's no fear out there. And that doesn't mean that it can't change on a dime, but right now there's no fear in the markets. Okay. And if we come over here and look at the bond market, you can see with the bond market here, we first started getting short bonds back over here in the summer of 2019. Now, there are a number of different ways you can exercise that bias or that opinion. You can go long TBT, you can go short TLT, or you can go short bonds. So I had suggested to our members, because most of them aren't, some of them aren't into the futures market as much as others. So I'd suggested TLT puts back up in this area here. And away we go. You can see this regression channel here. We're now running a sideways pattern in the bond market. Now I want to see if it reverts back to its downward trek, but we're on the upper boundary of the downward vector that the bond market has been on since last August of 2019. Okay. And of course, if we look at the 10-year interest rate, it's going to be just the opposite. You can see here, it's on the lower boundary of the upward vector of interest rates. So this suggests to me that we may be in a chop for the next 30 days, high to low, on both the bond market and the interest rates, because interest rates, obviously the interest rates are driven by the location of the bonds, right? So the appetite for the bond market drives interest rates, which then drives currencies pretty much around the same, as well as then it affects the equity market. That's why I always tell our members, you must understand the relationship between the credit markets and the various bond bills and notes and interest rates. Once you understand that, then understanding the flow of money into equities makes you a much better trader. Okay, so that's kind of what I'm seeing. And if we look at currencies, well, there's a big bet right now on where the dollar is going to go. Okay, you can see here, if I just step it out, you can see for the entire year of 2019, okay, the bond market, or the US dollar, has been making higher highs and higher lows. Then all of a sudden, towards August timeframe, same thing with interest rates starting to move a little bit higher. The dollar's been moving lower because we've seen a little bit more strength in the euro. Remember, the euro is about 58% of the value of the dollar index. So the dollar index is really controlled by where the other currencies go and where money is flowing. And you can see since August, just like the bond market, the US dollar has been making a series of lower highs and lower lows. So now we're in this with this area here, or this patch, where we're inside this upward vector and we're also inside this downward vector. So which way is it going to go? Okay, you can see here just barely that circle is the 50 EMA crossing below the 200 EMA. I think the dollar is going to find issues and reject this upward vector, right? And roll over and come back down again. Now, a lot of this is dependent on the strength and the health of the European markets, which is very weak. But if we see Europe start to stand a little bit firmer in their PMI data and what's going on there, same thing with Japan, then that's going to drive the dollar lower. So that's a little bit about what I'm seeing there on the dollar. Now, there's other things that we're dealing with our members on the pound, and the yen, as well as the Australian dollar. But for this weekly roundup this weekend, this is all I'm going to focus on right now. So the jury's still out on the dollar, but I do believe it may run up a little bit, but I think the odds do favor it peeling back again. Okay. If we look at gold, well, gold has broken out of this channel here. We've had this again. We had a nice long signal breaking out with gold right here back in June of last year, and it was a great run up. Now we chose to play it with silver because the relative performance of silver was better than gold, and now it just had this profit taking mode. My target for gold, once buying really came in, which once we break this area here, my target was around 1640. It actually got up to 1613, so I missed it just a little bit. And now we're going to be in a consolidation mode before we determine the next direction in gold. I think the odds do favor gold to go a little bit higher. It has a little bit of this kind of cup and saucer kind of pattern like this. The ideal cup and saucer would be, the dip, the handle would not run up this high and then peel back, right? So although it's not ideal, the typical run is 10% higher than that original pop out right there. So because we only went up here for just 2 days and then we immediately came right back down again, I got to look at this to say, well, is it a fail? Or is it just going to consolidate a little bit more before the run? So the jury's still out on it, although I think the odds favor a little bit of a move higher. Okay. Now we played the silver market in that. The other thing that I had our members looking at was copper. As China goes along, so will copper. Now I had a couple of trade recommendations for our members. There are a few members that made some really good money in the copper markets, and there are a couple of different ways to play it, not only with ETFs, but with the futures as well. Now, one area that I'm watching very closely is Palladium. Look at Palladium. It's just through the roof, right? And if we look at it and we look at the highs here, it's not even the high. Let's just take it to the high. The high was 2290, almost 2300. That is huge. This is a runaway market. And there's a lot of volume coming in here. A lot of people believe that Palladium is going to go even higher. And we're at all-time highs. And trading the short side can be very difficult because there's no options in this market. Not only the ETF, but the futures has no options. So you've got to hold the position, which means movement is going to be more erratic, both up and down, because you can't hedge the cross position with an option contract or contracts. But I do believe the backside of this is going to be very ugly when it finally comes down. So we're going to play it. Now, we've already played it before when we had a signal last summer. It was about a $23,000 per contract trade for us. Now, remember, this is for more of a higher net liquidity type account. If you've got more than 400,000, 500,000, then you could trade this effectively on a daily chart. You can trade it on a 5 or 10-minute chart, but you're going to get chopped a lot unless you're a very good day trader with a smaller account, because it's $100 a point. So it's a very big contract. Okay, very big contract. If we look at oil, well, oil had this nice run up here. We shorted this run up right here, and I was recommended pretty much the same thing: fade that move and fade that move. Okay, and all of these. This one was the missile strike on the refineries, the cruise missile strike by Iran on the refineries in Saudi Arabia. This was the U.S. Takeout and the Iranian strike in Iraq on U.S. locations. So both of these moves, I think the higher probability move was just to pick up a put in the futures market in oil and hold on. And those that did made some really good money. Now we're going to probably run a little bit of a sideways move here. I think over the next decade, oil is going to be lower, but in the near term, I think the odds favor it to run up just a little bit. It's going to be based on more on the global growth story than anything else. All right, everybody, that's kind of where we're sitting. One other thing, nat gas is down very low. We took an attempt to do some out of the money bull put spreads in that. I shut it down very early. I just didn't like the price action and what was going. So that told me that it could probably run a little bit more to the downside. Okay, possibly down to 1.9. Now, if I put it on a weekly chart, you'll see just how low this is. We haven't been this low since going back to 2016. So that does mean that yes, we can go low. We can go even lower. Okay, much lower, but it's very unusual. So getting back on the daily chart, you can see here that yes, it can go much lower, and that's where I think there's just an abundance of nat gas in the market right now. So it's not worth trying to fight the tape on this. Just let this thing settle in, get a good trigger for a long trade, and then let's play it. All right, everybody, have a really great holiday weekend. Members, as a reminder, we will not be doing our weekly market watch this evening. I will pick you guys up this Wednesday morning for our pre-market trader session before the markets open. Take care, everybody. Ciao.